In today's video, you are going to learn one of the most profitable strategies that I've been using in 2024 and that you can use in 2025 going forward. This video is sponsored by FastBull. More on that later. So this strategy uses a price action. If you are using price action, there's almost three things that you want to do always before you place your trades. Number one is to identify key zones in the market. Number two is to wait for the market to get into those zones. And then number three, you are going to wait to get entry signals or entry triggers in those zones so that you can place your high probability trades. So let me show you how to identify key zones in the market, and I will also want to show you how to wait for the market to reach into those zones. But obviously I can't teach you how to wait, so you have to figure that out for yourself. Number three, I'm going to show you one of the best entry triggers that you can get in those zones and how you can get high probability trades in the market. Now, if the market is moving, it always moves in two directions. It's either ranging and it's not in a clear direction, or it's either trending where it is in a clear direction where you can see if it is going up or down. Now, if you are trading using price action, you have two options. You can either wait for the market to go clearly into a trend and you start trading, or you can wait for the market to range for a long period of time and then you wait for that transition when the market is going from a ranging market into a trending market. That's where you get a high probability trade. That's where you can get high and most pips before the market gets into a long trend that is going to be coming. By the way, let me tell you about FastBull in a few seconds. FastBull is an all-in-one trading platform that allows you to do many things in one website. First thing that you can do on FastBull is they have a free charting software where you can analyze the market and you can get all the instruments that you want, and you can open up to 64 tabs for free. Number two, they have the economic calendar. On the economic calendar, you are able to see the upcoming events that can change the market movement so that you can either trade with the news or either you can avoid getting in the market. You can also copy trade from traders who are already making money in the market. So you can connect your account to other people's accounts. You can also chat with other traders using their trading chat room. Make sure you visit FastBull using the links in the description below or in the pinned comment. Okay, so now let me show you a strategy, right? So let's say you go into the market and you go to 1 hour time frame, 5-minute time frame, 15-minute time frame. If you look into any market, you are going to see that most of the time there is going to be time when the market is ranging and it's not going to any clear direction. In this case, you can see the market has been ranging right here. So from here, the market was just going up and down, and then you can't see if the market is in an uptrend or is it in a downtrend. So how do you trade this kind of a situation? Okay, so what you want to do is you want to draw a box, right? So this box is going to represent your support and resistance, and is going to help you to measure how many pips have the market been ranging right here. So what you want to do is you want to draw this rectangle right here. So the way that you draw this, right, if you are on FastBull, you just want to go to this toolbar here, and then you take the rectangle tool and then you draw. So when you draw this rectangle, you want to make sure that there's two touches, at least two touches to the upside, at least two touches to the downside, so that this rectangle can be a valid support and resistance zone. In this case, if I draw a rectangle like this, it doesn't have to be very accurate, but if I draw this rectangle like this, you can see that the market have touched here once and twice here. You can also see on the bottom side it touched once and twice, right? We have also another zones here very close to the bottom, right? So if you want, you can adjust it like this and you get 4 touches to the downside and then you get 2 touches to the upside, which makes this a clear ranging market. You can see the market has been moving in this range for a long period of time, right? So now, how do you place a trade in a situation like this? Well, now what you want to do here is that you want to wait for the transition of the market going from this ranging to a trending market, because that's when the market has the most volatility, right? So what you are going to do is you are going to wait for the market to break either below or above this zone, and then you are going to place your trades, right? And once the market breaks here, you want to place your trades. But if you do that, there's going to be one big problem that you are going to get, right? So the problem is going to be like this, right? Let's say you were trading this market right here, right? And you were looking to place your trades, right? And you see this market which was ranging right here, right? So the market was ranging. So you can see here the market was ranging, and then You see the first touch, second touch, right? And then you see the market breaking up outside of this market right here, and then you buy, right? So you were supposed to buy right here, but what is going to happen is that the market is going to create what is called a fake out. So a fake out is when the market breaks outside of a zone and then it comes back. And why does the market do this, right? The market do this firstly because the market is not controlled by one person. It's going to be millions, if not billions, of orders that affects how the market moves. So all those orders are not going to be filled at the same spot. Also, the other thing is that traders like banks or other big players in the market are going to create these false breakouts so that retail traders can fall for them, and then they are going to lose money, right? So how do you avoid these fake breakouts, right? So if you come back to our chart right here, what you want to do is you want to wait for the market to break and go outside of this zone, and then you let it go, and then wait for the moment that the market comes back into this lower zone, right? So let's say the market, let's say here the market breaks to the downside right here, and then you want to wait for the market to come back up into this zone right here. So all you have to do is just extend your box to go forward, and then you have patience to wait for the market to come back into this zone. The most important part about this is the ability for you to wait for the market to come back into this zone, because what is going to happen is that most people are going to see these small reversals here, and then they are going to think that the market is never going to come back into this zone. But if the market have created a range in this zone, right? If you think about it, if the market have created a range around this zone, that means there were a lot of buy and sell orders in this zone. If you even go to the higher time frame, you're probably going to see that this is a small zone, but it have got a lot of wicks to the upside or to the downside. So for example, let's say we go to the daily time frame, right? If you go to the daily time frame, you're going to see that this is a very small zone with a lot of candles right here. So the market is probably going to come back into this zone. But let me show you how you trade this type of zone, right? So what you want to do is you want to wait for the market to come back into this zone right here, and then this is when you start looking for entry triggers. Now on the entry triggers, the first thing that you can use right here is a trend line. Mostly if the market breaks to the downside and comes back, right, it depends on how big this first breakout was, right? So what I mean here is that if this breakout is big, right, it is going to take a lot of time for the market to come back into this zone, and when it takes that time, it's going to create a small trend right here, and then there you can draw trend lines and you can place your high probability trades. But sometimes the market is just going to make a small move and come back into that zone very early. So what you are going to do is you are going to look for shadow candles or bearish engulfing candles or bullish engulfing candles. So if the market comes back into these zones, you are looking for candles that have got bigger wicks to the upside, or where you have the second candle completely engulfing the first candle right here, right, which is called a bearish engulfing candle, right? So that was an entry trigger, which was more likely to give you a high probability trade because it was a big bearish engulfing candle. Also here you have got the market creating wicks, bigger wicks to the upside of all these candles. It shows you that this market is resisting to go to the upside. Now when this happens, you have confidence to say, okay, the market firstly was ranging in this zone right here, right? So the market was ranging in this zone, it breaks out right here, it comes back into this zone, and it starts to be rejected, and then you place your trades right here. So let me show you how you place your trades right here. So there's one very important factor that you want to use when placing your trades right here. So let's say you want to place your trades because of these candles that are creating big wicks to the upside, right? So let's say you want to place your trades based on these candles that are creating big wicks to the upside. What you want here is you don't want to place your trades right on the close of this candle. If this candle, so let's say this candle was the candle that made you make the decision to place your trades, you want to place a sell stop below the lowest point of that candle or the previous candle. Why do you do this? because if the market is right here and if it's not reversing right here, it will probably going to create another bullish candles and go to the upside. So you want to place your trades below the lowest point of the previous candle, so that if the market breaks that previous candle going down, there's high chances that your trade is going to be triggered when the market already have the momentum to go to your direction. I hope that makes sense to you, right? So after this, you can see that the market pushed to the downside. So how do you place your trades here, your stop loss and your take profits? Okay, so the way that you want to place your take profits and stop loss here is that you want to so let's take the order 2 here. So what you are going to do here is you place your sell stop right here, right? Or let's say you were using this bearish engulfing candle right here. This is much clearer, right? So you are going to place your sell stop right here, and then you have 2 types of stop losses that you can use right here. You can use an emergent stop loss, which is a stop loss which is just above this zone that you are placing your trade on, and then you use a 1-to-1 or 1-to-2 risk to reward ratio. Or you can use another stop loss that goes directly. So this stop loss is not likely to be triggered. Most of the time the market is going to get room to just move and hit your take profit if it is going to hit your take profit, right? So let's say maybe your take profit was here. Okay, so the first stop loss, you just put it just above the candle, the candles that you are making the decisions to sell with, and then the other stop loss you can put it on the middle of this box right here, right? So if you do this, you're going to have your trades looking like this. Okay, so firstly, you want to find a market which is ranging. You want to draw a box on that range. You want to wait for the market to break either to the downside or to the upside, and then you want to place your trades. I'm going to show you another example right on this chart right here, right? So if you move just before, you can see that we have here the market was ranging, right? So if you look here, you can see the market is ranging. It's pushing to the downsides, to the upside, right? So you can see the market pushing low here, pushing up, pushing down, pushing up, and then it creates one touch here. So the first one here, the second one here, we have the first one here, the second one here, and then we see the market breaking outside of this box, right? It breaks with it almost always breaks with momentum, right? So once it breaks with momentum, the next thing that you want to do is you want to just extend this box right here, right? So you touch the upper side and the lower side, and then you want to extend right here. So once you extend right here, you're going to see something that happens here. You can see the market breaks to the upside, right? After this range, right? After this range right here, the market breaks to the upside, right? And then it comes back into the zone right here. Now, it's not always going to be directly on the box or on the zone, because this is the market. It's not something that you can, it depends like on your brokers, it depends on a lot of things. Why you can't just go directly into your zone. So you have to judge this with your own mind and see, okay, this market came to this zone. So here was another good trading opportunity, even though the market didn't really touch the lowest point. Depends on where you draw your support or resistance. So here you start seeing candles with bigger wicks. These are going to be your entry triggers. Now, this one is not very clear because this is not a bullish engulfing candle, and this bullish candle here is not bigger than this bearish candle. So probably this one you were not going to place your trades. But I just wanted to show you an example of the market ranging, and then it comes back into that zone, and then it goes to the upside. So let me show you another example in the same chart, right? So there's a lot of times when this happens. If you start paying attention to it, you are going to see that you are going to get a lot of trading opportunities using this strategy, right? Okay, let's look at another example here. Okay, if you look at here, you can see the market moved into this zone right here, right? It started moving up and down of this zone, creating a rectangle or creating support and resistance. And you can see the market pushing up and down of this zone right here. So you have your first touch here, your second touch here, first touch, second touch. You have more touches here. You can see another one here, another one here. Although they are not accurate, but you can see that this market is clearly ranging. It's not either going up or down, right? And then it breaks to the upside, right? If it breaks to the upside, you are looking for what? For buy trades. But you can't just buy on this breakout right here, right? You want to wait for the market to come back into the zone before you place your buy trades, which happens, you can see right here on this zone right here. So you can see the market coming back. What does the market do when it comes back? It creates long wicks. These long wicks are just rejections, right? So these wicks simply means the market is being rejected to go to the upside, to the downside here. So there's a rejection on this zone right here. So that's why you want to use this zone as your entry trigger for this trade. So after these rejections, there's a bullish candle here. So that's when you place your buy trade. You place your image and stop loss right here if you have a small account. If you have an account that accepts bigger trades, you can place your stop loss on the middle of this box and then your take profit. So for your take profit, here's how you take your profit, right? So you want to look to the left of your screen, right? So you want to look to the left of your screen and you're going to see which zones are the market likely, is the market likely to, so which zones is the market likely to be rejected again. So in this case, you can see there was going to be likely a rejection on this level right here. Also, there's likely to be rejection here. There's likely to be rejection here. So you probably are going to put your stop loss either here, or you put here, or you can also put above here. In this case, you can see the market moved all the way up here before it started to be rejected. And you can see it started to create another ranging zone right here. So in this case, you can see after the market reached this zone, it started creating another range. So if you come here, you can see the market is now ranging again. Now all you had to do here is to wait for the market to come back into this zone right here. So I don't know in this case if it does come back. It didn't. It just continued going to the upside. So there's a lot of times when this happens, before the market changes direction or moves from up to down, or if the market is moving to the upside, sometimes it creates a range to create that momentum to keep pushing to the upside. So if you think this video was amazing, make sure you like this video and also make sure you subscribe to the channel if you are new. If you want to get daily signals and tips on how to trade, make sure you join our Telegram. Link is in the description below.